Hello, traders. Today, our special guest is David Cervantes. David's handle on Twitter is at Pinebrook Capital. What's Pinebrook Capital, David? And welcome. It's really a pleasure to meet you.
Thanks for having me on the show, Bill. Pinebrook Cap is my personal investment trading vehicle. It's an
Okay.
LLC, and it's a vehicle I use to manage some capital that's mine and to some friends and family.
Okay. So
Um,
you're okay. You trade and your family trusts you.
I hope so. I got to see them at Christmas, so that's kind of
Huh?
it's
Have
kind of
you
a
ever
double-edged
had a
sword.
have you ever had an uncomfortable Christmas and they threw some coal in your stocking?
Luckily, it
Because
has
coal's
not
hard to
happened.
get now. Coal's
Yeah.
more expensive now.
Luckily, it hasn't happened. There has been some times where I've been a little, have my tail between my legs, but
Yeah.
nothing bad.
No one really understands and how at times the psychological attachment to other people's money, especially people that you're close to, that are part of your life, sometimes is too tough for me to do it. I'd rather have them be my family than have, a bad quarter, upset things.
Yeah,
You know what I
there,
mean?
there, there, there's a sense of a tremendous responsibility and a sense of
Yeah.
trust that I
Yeah,
think
that's what I
comes
mean.
with it, and it makes it definitely elevates the level of care. These are not random people. These are people I
Right.
love, who I'm close to,
Yeah.
people
Yeah.
whose livelihoods could be impacted.
Yeah.
I do take great care and great responsibility.
And I saw this morning, maybe the other day, you took a 30-mile bike ride. So you find it important to keep your head clear, and you do it by staying in shape. I've heard that, in a way, we're like athletes. We're, in our best performing state when we feel good.
I think that's right. I mean, you got to have a clear head. Judgment is a real part of this job. And to have clear judgment, you need a clear head. You cannot
Yeah.
have cobwebs in there, and that involves soup to nuts. Rest, diet.
Yeah.
It's good to go out and have a good time, but you need to be on your A game for this
I'm
business.
glad that you can't see inside my head.
Yeah,
Anyway, David, I always find it fascinating the journey that people go through that have been in the business for a while, and um, viewers like it. And I'm always curious. I know you went to the University of California in Santa Barbara. Good choice, great location. Were you
hard
thinking
place to
about,
leave.
yeah, were you thinking about markets then? What was the first thing that attracted you to the financial markets, and what were you doing before you decided that this was going to be where you were going to put your complete focus onto?
Yeah, so I think that for me it was really a question of I was actually living, excuse me, I was living in France when I was for part of my college time, study abroad, and then I stayed there. And I was, this is now 1994. The Euro project is running
Yeah.
full steam ahead. And I was just trying to wrap my head around everything that was going on in around me. And that kind of linked up history, politics, economics, and I was just really just trying to wrap my head around it. I found it fascinating.
Okay.
And that kind of took me down down the rabbit hole of trying to understand economics and financial markets.
It's the greatest jigsaw puzzle out there, isn't it?
Yeah, I liken it. I try to liken it like to a ball of yarn where you pull on one end and you have no idea how the rest of the rest of it's going to untangle, and trying to figure that out is
Yeah.
fascinating, frankly.
Yeah. That's a nice metaphor. So that means as you're pulling the string, and I bring it up, um, we always have to assess and reassess as we're given more information as the string is pulled. And what I found was the big paradigm shift for me was really taking to heart what W.D. Gann said, that if you don't learn how to change your mind, you won't have any change left.
That's a good one.
And
You know,
plus, I
I,
experienced not changing my mind and not have any change left. a few times in my career. So now I think, really, that's one of the main things I teach is don't be stubborn and attached to a narrative. Price is king.
It's a good, it's something that George Soros talks about a lot, the concept of reflexivity, which is basically, it's a fancy way of saying feedback loops. And financial markets, I think what makes them so hard to understand and do well in is we have constant new information, which creates behavioral changes, which impacts the economy, and it's just really hard, if not impossible, to forecast a lot of that. So that this concept of reflexivity, feedback loops, and to your point, dexterity. If you don't have the dexterity to understand these feedback loops and try to game them out, it's going to be a hard time.
Yeah. So, okay. So you're in Europe and the Euro's launched, I think it was 85 cents when it first went into the market. I missed trading the Deutschmark. Used to trade Deutschmark Swiss spreads, but um, so you're trying to wrap your head around. You start reading. Did you change your course of studies at what was your major there?
I double majored in economics and international relations, kind of consistent with
Okay.
those areas of interest. And coming out of college, I got recruited by Wells Fargo into their credit training program. So really learning the nuts and bolts of credit underwriting for the middle market companies. That was a 2-year program, and I was, on path to become basically a credit officer. That did not appeal to me. So literally just bought a one-way ticket to New York City. I had a friend from Paris that was living here and couch surfed it. And it was the 90s. So, back in the 90s, it's, .com. Everyone's leaving Wall Street to go work, seek their fortune in .com. And, I had language skills. I had a pulse. They needed bodies, and they figured, look, you speak languages, French and Spanish. We'll get you on our international desk. And I got a job within 6 weeks. I was flinging emerging market fixed income.
With who?
JP Morgan.
Oh, nice. Okay. So you know what? You had a nice road. Can you imagine what people have to go through that perhaps didn't have your education level and opportunities to be with the best? Some of them just say, well, okay, I'm going to be in finance, and they scour the internet, or they become a broker, which is really a salesman, and don't learn how to trade. I was fortunate. I worked on the floor of the CME. So that's where I learned. I was running orders when they were trading currencies on chalkboards.
Wow. I mean, we were writing our books on, we had, trade blotters. We had as a pencil and paper, and I remember getting an ISDA. It stands for International Swaps Derivatives Association. It's what allows institutional traders to engage in complex derivative trades. Getting an ISDA was just, back then, it was just, you call someone, you go pick it up, and you fill in the template with pen, and by the end of the day you had a ISDA agreement. Now it's going to be a deeper level of diligence, and I think it's better. But things were just different back then. Whether it was on the floors where you worked or where I worked, it was a different time.
Yeah, I'm so glad I have you on, because I posed this question to a lot of my guests, and I want to know if my conclusion is right. Why don't I share my charts? So can you explain to me, David, why the technical structure of junk, HYG, and corporates are better than the structure that I see in sovereigns?
So the answer is, I'm not a great chart reader, but I have done some work in this area. Did a thread a while back where I was looking at the relative behavior of high yield bonds versus investment grade. In particular, I looked at the triple C, kind of the worst of the worst.
Okay.
and that was outperforming. So the takeaway for me was that, the business cycle is quite strong. We've seen some spread compression in the worst of the worst. The triple C has really just hit out of the park. So when you've got the worst of the worst outperforming, it's a tell on either the strength of the business cycle or investor confidence in the business cycle. Usually they go hand in hand. So I'll take that. I'll keep it simple.
Okay. Are they ever wrong and they get aggressive in that sector at an inflection point? Because I mean, let's face it, it's not news now. For a while it's been soft landing or no landing, and now it's no recession. And I know that I've read your stuff. You didn't think there was going to be a real estate crash. You've been talking about the economy humming. Um, when do you know you're at an inflection point? And would you consider that kind of like a lagging indicator? It's just like right now, everyone's constructive. Could there be something like government shutdown in October that continues to shake confidence? And do you think that the banking crisis that we had is over? Because I heard this, David, in Australia, they're limiting cash withdrawals at some banks to Australians to $500.
Wow. So to answer, a lot to unwrap there. So
Yeah,
first
a
off,
lot. Sorry
first
about
off,
that.
no worries. It's Monday morning, so that's what I get up for.
Yeah,
um, so
there's
bond
John.
bond spreads are a coincident indicator. They kind of tell us what's going on in the now.
Right.
They're
Okay.
not terribly forward looking because tomorrow if something happens, right, these things can flip on a dime and spreads can blow out. We saw it a lot back in the late 90s with emerging markets, and we've seen it through different crises where things kind of look fine until they're not. So I
Right.
take this. I don't take them as predictive. I do take them as more of indicative. So this is where things are now. It's the state of the now. But the state of the now is there is an aggressive investor appetite for risk, and that in itself can be somewhat predictive. In other words, I don't expect things to fall apart tomorrow. I don't expect things
Right.
to fall apart the next day. So that's the
Okay.
answer to that. To that.
Well, I mean, could you also interpret it that people who are buying HYG have more confidence in being repaid with them than sovereigns?
So the answer is, you have to take this apart. You have credit spreads, and then you have risk-free spreads. So the sovereigns and the credits are two different animals, right? One is basically interest rates, and the other one is business cyclical business sensitivity. So
Okay.
I would keep those two separate. And right now, credit spreads rallying, meaning tightening,
Yeah.
compressing is bullish.
Okay.
Now,
All right.
get back to the what's the big risk? You mentioned the shutdown. I think we have a potential risk event coming up a lot sooner, and that's the Jackson Hole confab that Powell will be delivering. It's a policy wonk
Yeah.
conference, and obviously Powell will be delivering the real. What people are going to look for is the Fed done? Are they going to, what's the Fed coming out with? What's the policy angle of the Fed? So that's what people are going to be looking at in the next up soon.
Okay. So I know you trade. Okay. You trade some futures for yourself, right?
That's right.
All right. So you were short the note. So, I'll pull up the 10-year yield. So you were making money as yields were going up. And we had a little reversal Friday, and you covered pretty well up there. Nice ride. Good out, David. Nice out.
That was honestly, that was luck. We got to call it what it is, and it's nice to take the victory lap and claim credit. So I can give myself some credit for maybe the framework and the
Yeah.
approach, but the timing was serendipitous and luck. So let's just
Okay.
call it what
Well,
it is.
yeah, sometimes good timing is due to your intelligence gathering. And, I talk to a lot of people, and there
Yeah.
are people whose work I respect, and I actually saw your tweet saying you don't like to be on the other side of somebody, which also may have played a role in your decision to get out.
That's right. You know, in trading, a lot of it is really it's fundamentals, but it's also, you know, what the crowd is doing. It's really an exercise in crowd watching. What's the crowd doing? And you know, you can have your fundamentals and your framework and your analysis all, you know, you have your I's dotted and your T's crossed, and you can still get it horribly wrong if the crowd, you know, moves against you. So it's definitely an exercise in crowd watching. Someone, a trader, a CME, a former CME, Euro dollar futures pit trader from the Merc. I saw him, you know, take the other side, and that for me, that was, you know, an exercise in crowd watching and watching the smart money, the smart people in the crowd move.
Yeah.
And I didn't want to be on the other side of that.
Yeah, I mean, you know, sometimes, you know, that helps me, and that, you know, that explains the importance of having some kind of community or people that you interact with that, you know, you're not dependent upon them. You still could do it without them, but it gives you more of an edge than you would have without them. So kudos to whoever it was. If you want to mention his name, that's
Yeah, his name is Donnie. He goes by the handle off memory. I think it's DCP Cooks.
oh,
So
I'll
I believe
follow him.
I believe that's his handle. But I respect his work. I respect him as a person. He's an honest person, and he's sharp as a whip.
Okay.
And he's, you know, he's our generation. So he's old school.
Okay, so here's an old school pattern in yields. You know, we last week, and it was before the recent spike in rates, I proposed this question to my team and to people that watch my analysis. I said, well, and that's when, you know, that was here. I posed the question, I go, well, with all the great benign inflation reports that we've had, 12 in a row, and some reports also besides inflation showing, you know, it would be benign. Why weren't 10-year yields already at 330 instead of holding above a weekly breakout? And
So, okay,
go
I'm
ahead.
sorry. Go ahead. No,
No,
go
go
ahead. Go
ahead.
ahead. So yeah, I approach fixed income a little differently than most people. What I do is I actually deconstruct, you know, the rate structure and what does that mean?
Okay.
You know,
You don't use
nominal.
charts at, do you use charts at all?
No, I could barely read a chart. I mean, I know what a moving
All
average
right,
is.
I'm going to
I
get rid
think.
of these
No, you can leave it.
archaic.
That's fine. That's
All right.
fine. You know, I kind of know what a moving average is, and I think I've heard of an RSI, relative strength index. But
Yeah,
that's, you know, I'm really not a technical person at all.
you're a fundamental guy.
I just don't understand it, and I
All right.
think fixed income in particular lends itself to I think a different framework that for me at least.
Okay.
And so I took apart the nominal curve structure, and I basically proposed that you could have losses, cash losses in fixed income, meaning rates can still go up with a disinflationary impulse, meaning inflation can stop accelerating. It can actually go down, and you can still lose money. And the reason is real rates. So you have real rates. Nominal rates are composed of real rates plus inflation. And if real rates are accelerating and overcoming the disinflationary impulse, you can still lose a boatload of money. And that was my thesis, my premise. Real rate, and the reason real rates were accelerating was because the economy is accelerating.
Okay.
So, you know, when I was looking at the economy and looking at disinflation, you know, I was noticing real rates were still popping up, and then I said to myself, well, you know, this is not making any sense, and if real rates keep accelerating, which they did, then we could be in for, you know, for a problem. So I shorted the notes. The timing worked out well in terms of the entry at 378 roughly, and I got lucky and got out covered at I think 418.
Okay. Your thesis hasn't changed, has it? So it's just a matter of perhaps the bond market corrects from here but longer term, your thesis is still valid and that you still see higher yields coming down the road, like 4.5 to 5% by year end?
I mean, I don't have an explicit target. My premise is that in fixed income land, in addition to reals and inflation, you also have what's called a term premium, and it's basically what investors either under or overpay for a risk-free stream of cash flows. Now, what does that mean? You can take a stream of cash flows, discount them at the current rate, and have a price. It's real. This is just simple discounting math. But if you're uncertain of those cash flows, then you will say, I'll pay a discount. I don't want to pay that much. Or if, on the other hand, if you're terrified of the economic environment and you want that guaranteed U.S. government stream of cash flows, you'll say, fine, I'll overpay for those cash flows. It's kind of like the way you use in equity land, where you see PE expansion and PE contraction, where you can have the quote unquote fundamental value, and then you attach a multiple to it, and the stock gets more expensive or less expensive. So it's risk premiums are kind of the equivalent of a PE in fixed income land. And my thesis was that the economy is doing great. Inflation is coming down, but people are still overpaying for a fixed stream of cash flows as if a recession were coming. And that didn't make any sense to me. So in equity land, the equivalent would be, Apple stock is trading at whatever multiple, or NVIDIA, I think is a better example, right? NVIDIA's trading at I don't know what the multiple is, 50, 70. I don't follow these things, but whatever.
Million.
Right. And I say to myself, you know what? This PE makes absolutely no sense. It's garbage. It's going to be traded at a 20 PE for whatever reason. So I'm shorting it. So it's kind of the equivalent approach to term premiums with fixed income. And so the 10-year had a very rich term premium. It was around 95 basis points. It was crazy.
Where is it now?
Excuse me. It was negative 95. Okay. When I covered, it was around negative 37.
Okay.
So that big move in rate that we saw last week was in large part driven not just by real yields, but more so by the term premium, that fixed income PE equivalent. So that was really what I was going after. If I'm a hunter, I wasn't targeting inflation. I wasn't targeting reals. I was targeting the term premium. So I was the equivalent of going after the PE for the 10-year note.
Do you think Japan is important to watch now, David? It seems, the yen has an impact on, their rates, and then spills over to our rates. And plus it's used in the carry trade.
Yep.
And if the yen becomes more expensive, it makes the carry trade less efficient. Should bond traders be keeping an eye on the yen?
I think that's more of a currency question. It does obviously spill over into other asset classes, but that's the first stop is currency traders. I know you do a lot of currency work. The reality is Japan is a creditor nation, so they have a lot of cash to put to work. They're gushing with money that they need to put somewhere, and with Japanese bond yields being so low, it's got to go somewhere. So it goes out, and these are massive capital flows that ultimately make their way into here. In part is part of its confidence in our markets. Part of it is just the size. We have very large, deep, liquid capital markets. We can absorb $1 trillion in flows. You try to put $1 trillion into France or Germany, good luck. It's just their markets aren't deep enough. We have the deepest, most liquid markets. So capital will flow here because we can accommodate it.
We're the cleanest dirty shirt in debt land too.
Oh, hands down, yeah. That's
just like currency land, clean and economically, we're the cleanest dirty shirt. I'm going to put some starch in it, but we've been hearing that for a while, haven't we?
Well, the answer is we have, and I think that's more of a political question. Fundamentally, we can print our own money. So, as long as we don't kick off inflation, we got a printing press that is the envy of the world, and we are the reserve currency issuer. So we have a lot going for us in that regard.
Okay.
But going back to Japan, so I think it's more of a currency question, and then the next stop after that is obviously fixed income.
Because there is
Those
a decent correlation. When the yen gets cheaper, it usually translates into higher yields here. And when the yen is appreciating, which we haven't seen for a while, it's safe haven buying and yields come down. So I just kind of noticed the correlation. It's not 99, but it's up there. It's worth paying attention to. You know, as a fixed income trader, do you pay attention to geo events, or does geo ever play a role as far as perhaps China coming out with a new currency, or escalation of the war in Ukraine, or China doing something, uh, militarily, or devaluing their currency? Do you look outside? I know because you have an emerging market background. Are there any things that you're worried about, since we're the best, dirty shirt? What about the rest of the world? At times, China has pulled us out of the doldrums. Are they dragging us into the doldrums? Could they?
the answer is, China could drag us into the doldrums. I don't think there will. I think their problems are more, China centric, meaning
Okay.
they're trying to fix. They've got two big problems going on. One is demographics. They don't have enough. They're not making enough babies, and that is not something that you fix overnight.
No.
That's not a that's a 2-generation policy problem that they need to address. So they're not making enough babies. There's a shortage of. We
Middle
are.
East. We are.
Well, we are above replacement rate still.
Okay.
So meaning we're still have net positive demographics in large part because of immigration.
Right.
This people still want to come to this country,
Yeah.
and they'll die trying to get here. And we need to exploit that to keep our demographic profile up relative to the rest of the world. That is our edge geopolitically, our demographic profile. Bodies. Ultimately, it comes down all competition, all geopolitical competition comes down to bodies, because it's bodies that make an economy, it's bodies that go to war, it's bodies that do things. And we have the best, hands down, the best demographics in both in the developed world.
Okay.
You mentioned the Middle
Right.
East. They've got very, they have a little bit of a different issue, which is they have great demographics, but they're not growing fast enough to accommodate them. So that results in, not the highest standard of living.
Okay. David, I think you should write a book. Have you?
I have not, but I do write a lot as kind of a way of just laying out my thoughts and keeping a log of what I'm thinking. Sometimes it's fun to go back and say, what the hell was I thinking there?
Yeah.
And other times just to keep myself honest. I think Twitter's been great for me personally, just to put thoughts out there, get feedback from a lot of smart people like yourself and the rest of the community. And it's a great feedback mechanism.
Well, it's a very complicated arena, what you delve into. And, you have the training, and you have the demeanor and able to explain it to people so that even I understand it.
Well, I still can't read a chart to save my life. So, there you go.
Well, we'll help each other out, David. I'm so glad I, brought you in here today. Most important thought going forward into the fall for traders, investors. What's your top of mind for you?
Top of mind is, I think, the recession trade was really strong earlier in the year. I was out of consensus. My view was we would actually have some economic acceleration, and we actually got that. We got the acceleration. I got lucky. Fine. What's the trade? I think that acceleration that we saw in Q2 and we're seeing in Q3. I don't think is sustainable. I don't mean that doesn't mean bear market. It doesn't mean what I think what it means is the acceleration trade got priced out. We're seeing some profit taking, and now it's kind of a wait and see moment. So I think I'm luckily I'm going on vacation soon, and I'm just going to kind of go on risk off mode, watch the markets from afar, see what Jerome Powell says and see how the economy evolves. But I think assets were priced to perfection, and I think we're going to see somewhat of an unwinding of that soon. It's already started a little bit. We're seeing a pullback in asset markets, and I think the enthusiasm that we saw over the past few weeks will kind of, markets are neurotic and schizophrenic, so I expect that enthusiasm to kind of maybe go the opposite side for a while and see how the economy evolves.
Yeah, let's just hope that the central bankers that are there, that they continue to lie and create trading opportunities for us.
Hey, they got their job, we have ours.
Let's hope we're doing ours a bit better.
Yeah.
Okay. Are you a fan of the Fed, David?
I actually am a fan of the
Are
Fed.
you a Jerome Powell groupie?
I'm a Jerome Powell groupie. If he was throwing
right.
a concert, I'd pay for front row tickets.
Okay. Number one reason.
Number one reason, I think his approach to policy blows away the last generation of policymakers. And what does that mean? It means he's not dogmatic. He's a lawyer by training, not an economist, right. Which I think gives him an edge. Meaning he's not drinking his own Kool-Aid. And I think if you go into a profession without the credentialing that the profession requires, you're going to work harder. You have more to prove. You're the scrappy kid on the block. And I think Jerome Powell, by not being a trained economist, he listens more. He is more open-minded. He's not dogmatic. I think if he was a highly credentialed PhD, he would be the smartest guy in the room.
In the ivory tower, right?
He'd have the
long-term capital management.
Yeah, he'd be the smartest guy in the room. He'd have a bunch of people that were yes people, yes men and women, and they would just go with it. And I think him not being a trained economist is his edge.
Okay, well, thank you for sharing your point of views. What a great interview, David.
Yeah, thanks for having me.
Our most valuable currency is our time. Thanks for spending some with us, David. My trading, you're my trading warrior brother now, right?
I am. I appreciate that. Thank you.
All right, and have a great trip, and let's do it again. I really enjoyed talking to you today. Nice conversation. Thank you, David.
Sounds good. Thank you. Take care. Bye.
Follow David at Pinebrook Cap on Twitter. Ask him questions and learn from this guy. Adios, David.
Take care.
Take it easy.
Bye.